Hello, everyone, and welcome to today's webinar, Investing in Early Stage Startups. My name is Michael Silber. I'm the event director of Enlit Australia, a conference experts for the energy transition focused on the entire supply chain from end to end. Enlit Australia is pleased to bring you this webcast along with Initiate, which is central and essential component to the Enlit global brand. Initiate is a global movement that spotlights talent, empowers the next generation of energy entrepreneurs, and you can learn more about Initiate at www.initiate-global.com. Now, before I hand the mic over to Trevor Townsend, CEO of Startupbootcamp and your host for today's webcast, I have a few housekeeping items to cover about today's session. First, today's webinar will be available on demand after the live session on www.inlitworld.com/Australia.com. We've also added some attachments which are available through the Handouts tab on the right side of your screen. Next, we'd love to hear from you during today's presentation. If you have a question for any of our speakers, please feel free to send it through the Ask Staff a Question box on the right-hand side of your screen. We'll be answering questions during today's session, but if we don't get to your question during today's webinar, we'll be sure to follow up afterward. And last, we'd like to encourage you to share today's webinar with your social networks. So without any further comment, here is Trevor Townsend, who will introduce today's speakers and talk a bit about the activities of Startup Bootcamp in the energy space. Trevor?
Thank you, Michael. Before I start, I'd like to acknowledge the traditional owners on the land on which we're having this event. I pay my respects to their elders past and present, and the elders of other communities who may be here with us today. As Michael said, I'm Trevor Townsend, CEO of Startup Bootcamp Australia, and I'm co-hosting this event today with my colleague, Abs Babulia. I'm in a unique position where I've invested in over 60 startup companies over my journey. My first dozen or so were as a sophisticated angel investor. I've made quite a few mistakes, but I've also been part of 3 IPOs in the US and Australia. Abs, would you like to introduce yourself now, please?
Thanks, Trevor. Hi, I'm Abs Babulia, and I'm the Program Director at Startup Bootcamp Smart Energy Accelerator in Melbourne. Since 2017, I've met, assessed, and run events around the world for hundreds of global smart energy startups. I've also accelerated 30 startups right here in Melbourne from 18 different countries, who combined have raised over $90 million in funding. Before this, I worked in the energy sector as a commercial analyst and as a renewables manager, both in Europe and in Australia. We have with us today a great number of expert panelists from various segments with different perspectives on investing in early stage energy startups, and they will share with us their views, their experiences, and their advice. Firstly, we have Stuart Allinson. So Stuart co-founded and led a Melbourne-based technology startup to an ASX listing in 2016. His focus is supporting startups and scale-ups to get to the next level, both as a mentor, an advisor, and as a non-executive director. Stuart is also a member of the Commonwealth Climate Change Authority. Next, we have Mark Bonner. Mark has 25 years of international business experience, including more than a decade in impact investing and clean tech venture capital. He currently serves on the boards of Sunman Energy, Wattwatchers, GreenSync, Benan, and Octillion Energy. Moving on to Adam Bumpus. Adam is a clean energy innovation expert, media presenter, and startup engineer. He is currently an Australian Research Council Fellow on Clean Energy Entrepreneurship. He is also the co-founder of RedGrid, a smart energy startup who gives a brain and a common language to the infrastructure and devices that are already within our grid. And finally, we have Avery Michelson, founder of UCapture, a green tech platform that harnesses the power of consumers to reduce greenhouse gases and combat climate change. Thank you all for attending, and we're excited to hear your insights. Please put any questions in the chat window that you will see on the right-hand side of the screen. We'll get to questions at the end of the session, so please load us up with plenty of curly ones. We'll look forward to answering those. I'll hand back to Trevor.
Thanks, Abs, and thanks for introducing everybody. So over the last 3 years with Startup Bootcamp, I've invested in over 50 startups, 30 in the energy sector. And of course, I've learned a lot in that short period of time, and I do remain optimistic about startup investing. The main reason why I joined Startup Bootcamp was to improve my investment returns by getting a portfolio approach, really. So having more investments and hoping some that will pay off. Over the course of the webinar today, we will share with you a little of what we've learned over the journey. And in the first few minutes, I'll explain to you about the stages of the investments that we're talking about when we're talking about early stage investments. So let's have a look at the different investment rounds. For those of you out there who like structure and financial precision, you're about to be disappointed. These terms are elastic and are largely marketing terms to set the scene. They're more often used to talk about the stage of the startup rather than their valuation or the amount being raised. And the amounts in these things, series and so forth, vary a lot from country to country. So please keep that in context with the country that you're in. So let's start with the very first source of funds for most startups, family and friends. This is the earliest stage investment. They're backing a good idea, and the startup founder is usually approaching colleagues, rich dad, rich uncle, and so forth. And these people are really backing the founder. They're backing the founder and maybe his good idea or her good idea. As an angel investor, I would suggest you never get involved in this stage if you do not intimately and know and trust the founder. So the next is the first professional round or some semi-professional round, which is really the seed round. Typically between 500K to 2 mil, but it can go beyond that. That's the first raise outside the founder's immediate family. Some of the family and friends usually do follow on at this stage because, again, they're usually well invested in the founder. At this stage, the company usually has what we call a minimum viable product and some customer traction. If they're in the hardware game, they've probably got a late stage prototype. If they're in the software game, they'll have some software up and working, showing the major features and so forth. The founders at this stage are usually stuck. They've probably run out of family and friends money or nearly have, and they need more money to get their software into production or buy equipment and so forth. Accelerators like Startup Bootcamp, we invest just prior to the seed round, often called pre-seed, and then we help the startup through into that seed round. The first professional round is really called the Series A. That's usually between 1 million to 5 million, but of course can go up to $10 million. This is when the startup's found its niche. We call this product market fit, and they're looking for funds to start scaling the business. And I do say start. At this stage, they've proven that there's a market for their product, but now they need funds to actually get to that market. This is a stage the VCs enter the game, and usually one or more will be a lead investor. Family offices often get involved at this stage and often follow a lead, and corporate VCs sometimes get involved at this stage, particularly if they're a good distribution route or a downstream customer for the startup. After this stage, we get into Series C, D, E, onwards through to IPO and exit. So we won't be talking about those at this stage. So really, seed and Series A are really the investment stages for early stage investment. So what actually determines the round? Essentially two factors: the amount of money that needs to be raised and the metrics that the startup has that de-risk the investment and proves out the valuation. It's really interesting that the general public can only really invest, arguably, at the highest risk and most overpriced investment rounds, crowdfunding and IPOs. And we'll talk to our startups today about crowdfunding and dig into that a little bit more too. So angels are really there to get the ball rolling. So why do they invest? Are they hunting unicorns, billion-dollar startups, or are they investing for love? An angel has about a 1% chance of finding a unicorn. That's the probability of finding the next Uber, Stripe, or Airwallex, or something like that. So why be an angel investor? Well, maybe the origin of the word angel can help. The term angel came from the Broadway theatre, where wealthy individuals gave money to launch theatrical productions. That was definitely a case of love, rather love more than money. Unless you've seen the movie The Producer, where they launched this film, Springtime for Hitler, to be the worst musical ever as a tax write-off, and it didn't work, and they inexplicably become successful. And maybe there's some lessons in that for our startup investing. But startups, angels really are there to help startups. They're really there to help startups take their first step. And they take a portfolio view of their investments and typically plan for 1 or 2 investments in 10 paying off. But they usually have deep affiliations to the sector that they're investing in. They want to see problems solved and they are interested in helping firstly, which is a great segue to ABS to talk about the energy sector and investing in early stage in the energy sector.
Cool, thanks Trevor. So I'll break this down into 3 different parts. First, I'll talk about how we recruit early stage startups. Next, I'll touch on some insights into the energy investment landscape, and I'll finish with what we look for when assessing an early stage startup. So we recruit globally for 10 startups we select each year for the Energy Accelerator. We start with a database of around 10,000 energy-related startups. We look for those that match the key themes that we have identified with our partners for that particular year, and then interact with around 4,000 to 5,000 startups by email. From this, we get around 1,000 applications, and we typically interview 300 to 400 of these startups during our selection process. Only 10 are chosen to join the accelerator. We have seen the themes change over the last few years, and with early themes in 2017-18 having a strong focus on IoT and energy efficiency. Over the last 3 years, we have seen a strong emergence of good integration of renewables and electric vehicle infrastructure. Before I move on to some insights on the sector, I have a poll question. So the question is, do you think energy is a good asset class to invest in? Yes or no? Next, I'll touch on some insights into the energy investment landscape. Drawing on the data from the International Energy Agency, we can see that energy investment is misaligned with where the world appears to be heading and also far out of step with where it needs to go. This is a climate change decade. The next 10 years will be crucial in managing and reversing the effects of climate change. Energy should be at the forefront in the world's push for sustainable development, but the investment data reveals a harsher reality. Energy investment is set to fall by 1/5 in 2020 due to COVID-19. Venture capital investment remained robust in 2019, with energy storage and hydrogen seeing the most growth. Total equity investment in energy technology startups stood at $16.5 billion in 2019. To put that into context, SoftBank invested over $18 billion in WeWork and Uber. I'll just let that sink in. Total equity investment in energy technology startups stood at $16.5 billion in 2019. SoftBank invested over $18 billion in WeWork and Uber alone. So we see there's a long way to go here. So let's have a quick look at the poll results and see what that shows. Yes, great. The market thinks so too. So let's actually dive in to what the market's saying. Of the $16.5 billion invested in 2019, around $4 billion was invested in early stage venture capital. So this is seed, Series A and Series B, which typically supports innovative firms through their most riskiest stages. Of the early stage funding, 35% was for low carbon transport, mostly electric vehicles and charging infrastructure. Other sectors grew significantly, notably energy storage, hydrogen and fuel cells, but also bioenergy and solar. Startups receiving funding have tended to come from the traditional powerhouses, the US, Europe, China and India. We're also seeing South America as a strong market. Deal size was particularly high in China and India, with startups there sometimes raising hundreds of millions of dollars in a single funding round, such as Hozon Automobile in China, who raised $450 million in one round, and Ola Electric Mobility in India, who raised $250 million in one round. European and US early stage VC deal sizes are also at an all-time high. This indicates investor confidence in new energy technologies to play a disruptive and profitable role in the energy sector in the next decade. There's another poll to kind of conduct. I wanted to dig a bit deeper into the next poll around which segments of the energy tech would you invest in. So we've got a few options: EV charging and other energy infrastructure, alternative energy renewables, energy efficiency, community energy, and another option. I'll talk about the results after I finish the last section off. So what do we look for when we invest in a startup and bring them to our accelerator? So at Startup Bootcamp, we focus on a number of factors when assessing an investment in a startup. Firstly and foremost, we look at the founding team, the experience, the structure, and most importantly, the domain passion. So why do the founders want to solve this problem? Do they really understand the problem from a customer perspective? And are they passionate about solving this? Next is the solution. Does the solution make sense? Is it as simple and as elegant as it can be? We see many complex solutions with complicated technology and poor user experience. This is the worst kind of startup investment, and it's unlikely there will be any real customer adoption. Next, we look at traction. What evidence of traction do they have? Have they been able to find a customer or a group of customers that are using their solution? If so, then we have some indication that the problem is worth solving and there may be a market. Then we move on to the technology readiness level, sometimes call it TRL. So what stage is the solution at? Is it a minimum viable product? Is it a working prototype? Or is it something more mature? From this, we can estimate what technical challenges lay ahead and how much funding is likely to be needed to overcome these challenges and get the product ready for commercialization. Finally, we look at the market size and the revenue potential. How big is the addressable market for the product? What costs will be associated with the go-to-market strategy? And is this achievable? What partnerships or alliances will be needed to scale the business? Other factors such as competitive landscape, patents and IP protection, existing investors and valuations all come into play. I just want to touch back on the poll and see what people are looking at in terms of the different sectors. Alternative energy renewables seems to be a big half of the votes. So we're seeing that as a big trend in this year and in this decade as well. It's really interesting to see. So now I want to hand back to Trevor to chat with Stuart Allinson, our guest angel investor today, and get his take on angel investing. Over to you, Trevor.
Hey, thanks for that, Abs. And it was interesting to see the segments that people are wanting to invest in. I mean, we see a lot of that around integrating renewables into the grid. I think we'll see more on the EV charging, but talking with Stuart earlier today about the energy efficiency side, the best form of carbon abatement is carbon you don't produce. So hopefully there's more on the energy efficiency side as we go along. So Ab said, Stuart Allison's our first guest, and Stuart, I welcome you here today, joining us. Thank you for joining us on this webinar.
Hey, thanks for the chance to talk as well, Trevor.
And you've just disappeared off the screen, or is that just on my view? Oh no, there you are. Yeah, that's great. So just a little bit about your background. You've had both the corporate, the consulting, and then also your own startup. Do you want to give us the 30-second rundown of some highlights there, Stuart?
Yeah, sure. Thanks, Trevor, because it gives some context to kind of the way I see the world as an angel investor. So I pretty much grew up in the energy market in the UK, offshore operations all the way through to the meter. And I came to Australia in 1997 as an energy market consultant with one of the big 4 consulting firms, worked on market reform. I then co-founded a software platform energy tech software platform that we listed on the ASX back in 2017. And since then, I've been working with various roles, either in an advisory capacity, a mentoring capacity, as a chair of advisory boards, chair of governance board, and I think Abs mentioned earlier on, I am a member of the Climate Change Authority as a board member of the federal authority there, which gives me quite an interesting perspective on our energy transition as well. So that's me in a nutshell.
Yeah, it certainly does. So I described an angel investor in the introduction. Do you see yourself as an angel, and what part of the characteristics of the angel investor kind of really go to your core? Is it love or is it money?
Yeah, and I love the tee up, and I'd forgotten about that theatre sort of reference of angel investor, because when I hear the term angel, I think fallen angel at best, right? Okay. Yeah. So I think it's probably fair to say with me, so my motivation, my passion, my love, if you like, comes from having survived and thrived as an entrepreneur and listing a business on the stock market. You know, some days you're just glad to be still breathing and still money in the bank. So to get there, you know, it's hard work, it's having a great idea, it's having some brilliant people around you to execute, but there's also a bit of good luck there as well. So my motivation is recognizing that, you know, it's a bit like the Darwinian sort of cycle, right? It's a numbers game. Some will make it, some won't. But if I can help any organization along the way, just to eliminate risk, to avoid going down, you know, cul-de-sacs, just to learn things that I took 3 years or 4 years to learn. If I can help in that process, then that's what I'm there to do. So for me, helping either can be in an advisory role or a mentoring role. I've been with the Startupbootcamp for the last 3 years, and I've thoroughly loved it. It keeps me current. I feel like I'm contributing back. At the end of that is occasionally the opportunity to invest if my money, my funds, plus my assistance can help. But it's the heart that gets you out of bed. When you get your money out your wallet, it's got to be ruled by the head, right? So that's kind of how I see the whole angel role, if you will.
Yeah, well, that's good. I think that does qualify you as an angel. And I mentioned unicorns before. For most people, coming across an angel might be rarer than coming across a unicorn. So for people who are starting their own business, do you have any advice on how they would find an angel investor for their company? And do you have any thoughts on how to pitch a proposal to that angel so that, you know, you catch their interest?
Yeah, great questions. So the first part of it is, I think that there's an aspect in which there's people looking for opportunities, and the survey that ABS has just conducted sort of speaks to that. There are people looking for opportunities, and then there are startups saying, hey, I need some help to get to the next level. And I think a key part of that is how and where that happens. And there's two things for me, and I'm going to risk offending every angel investor in the world and assisting every entrepreneur in the world by saying the start lens is you have to think of raising capital as, and I'll put it in inverted, it's just another procurement exercise. You're out in the market trying to get an input into your business, and you're looking for the features and benefits that go with that. So it's as much as about what comes with that money as the money itself. And then the related point to that is, how do I find it? And I think so often it starts a bit like searching for a job with a conversation. Where do I get advice? So you reach out to people to get advice, and that turns into further discussions. The other thing, and I'm going to give Startup Bootcamp a bit of a trumpet as well in this, Trevor. When you think of the numbers, it is impossible to think that I, as a hopefully informed investor, would get to see everything. So I look for these filters. If an organization has been through a filtering exercise, I've got to believe that the 10 or 20 that you've shortlisted have got some of the best ideas and talent that there is available globally. So for me as an investor, the meeting point of an incubator accelerator is a great way to actually get involved and to see what's out there. That's probably the best tip that I could give angel investors and startups themselves.
Yeah, well, just one last tip would be, if you're looking to become an angel investor, Stu, what would be the top tips you'd give to the individual who wants to invest and doesn't have the experience?
So I'd probably start with that idea of let the heart get you motivated, let the head rule your wallet. I think that kind of goes to number one. I think the number two is just, I think you nailed it before, Trevor, but I think it's worth reminding ourselves, it's a numbers game. You know, with the best will in the world, if businesses can thrive a little bit longer, get to market, get to revenue, get that next stage, some will fall over, some will morph, some might not get to the destination. So from an angel investor's point of view, be real. It's a numbers game. you can try and skew the numbers by de-risking, like understanding the investment and finding ways to mitigate that risk. That goes to my next point, really, about you've got to believe that you're going to be hands-on in some respects. I don't think I know of any angel investor that just says, here's money, see you in 2 years. They're passionate about what they invest in. They want to believe they can help. And I think that's a tip also for entrepreneurs, that they actually keep their investors informed. Don't live vicariously.
Yep.
Don't live vicariously. You're backing a team. You're not there to do their job for them, but really work out where their gaps might be and where you might be able to help, and getting involved. And I think probably the other thing I would say, 2 more things quickly. One, I know a lot about the energy market. I'm certainly not the font of all knowledge. I reach out to my personal networks to validate what I'm hearing. I also use it to validate market fit proposition. And I think the other thing, and it's a thing I've learned because I've put shareholder agreements together, I think the one big thing that most early stage are missing is the kind of governance oversight. So I'm always looking to put in place a decent shareholders agreement, and maybe have 1 or 2 people on the board that can really help, but don't kind of crush the entrepreneurs.
Yeah, that's really good advice, particularly that not wanting to crush the entrepreneurs in those early stages, because those companies are quite vulnerable, obviously, and if they're focused on the wrong things, you actually send them out of business, yeah, which is, and we've all seen that happen. So Stu will be around for some questions after at the end of this segment, and now I'll call Abs back up onto the screen, and I think he's going to talk to some real startups about finding investment. Abs, are you there, mate?
I am. Can you hear me?
I can hear you, and I can't see you yet, but I can see Avery. I can see Adam. Yeah, I can see everyone. Okay, we'll just
Awesome.
Over to you, Ab.
Thanks, Trevor. So we've heard from Stuart from the angel side. We'll also be hearing from Mark from the VC side. I thought it'd be really good to kind of delve a bit deeper from the startup side, and no one better than Avery and Adam to unpack this from a startup side. Both have gone through this process in the last year or so. So I want to kind of unpack the entire process of investing from a startup perspective. And I want to start with the timing. So at an early stage of a startup, you're trying to validate a market need, building a product, trying to find your first customer. There's a million things to do. There's a lot of uncertainty. So how do you know when the right time was to go seek funding? So Avery, I know you're doing this at the moment. Do you want to go first? And then I'll jump in to Adam and get his views on this as well.
Sure, great. And thanks for the opportunity to speak and to Enlit and Startup Bootcamp. So for us, every company is going to have a different when's the right time, but it was a lot about how much capital we had in the initial phases, and using that capital really wisely, holding on to that, stretching it out till the end, and then keeping an eye on how much dry powder, how much burn rate and months left we had. And one piece of advice that I got that was very helpful, very good, was to to really envision this process as taking quite a long time. You're not going to get the money quickly, and so if you need money in 3 months, you've got a problem. You need to start that fundraising process 6 months, maybe even 9 months or more before you need that. And so rolling the clock back is probably what you need to do based on how much money you have and your burn rate.
Adam, did you have a similar angle?
Yeah, I think Avery's exactly right there. Like, it always takes longer than you think it's going to take. And there's a couple of other things that for us really came up was, yeah, okay, you need money. You got to get out there and start talking to people. We got to start talking to them early and make sure you're kind of starting to align that strategic and philosophical alignment. And I think that's one of the big things is, right, okay, like we're in energy, and energy is weird and different. And so we've got to find those right investors who really believe in the kind of thing that you're putting forward, the philosophical approach, and then start to bring them into the tent, like as Trevor and Stuart said, then really communicate a lot and start to build that following. I think that is one of the critical bits about knowing when you're at that right inflection point where you say, cool, we open and now we get the money.
I think that's a really good point to kind of move on to the next part around raising capital as a process. And we do see this as a sales process. And we talk about building a database of investors and then going through the equivalent of a sales pipeline. Adam, do you want to talk a bit about your process in identifying the right investors and reaching out to them?
Yeah, so we did a crowd equity raise, so that was a little bit different. It's a new thing in Australia. It's a regulated raise, but it means we can go out and source a lot of different investors from different places. People from $50 to $150,000 could invest, and so we had to then put together a video, make a pitch that's really understandable, really nut down on what the problem is. And so for us, the sales process was really focus, problem. Oh, and here's the solution that's a bit different. We think can really nail this. And I think that was kind of what led us in that pitch, and just being as authentic as possible, like really just being out there and being yourself. And that's because they're buying you as well. As you said, we're early stage companies, got good ideas, but it's it's your team and your strategy and your ability to execute that people are putting their money behind.
And Avery, do you have a similar experience about that sales pipeline? And do you talk a bit about that?
Yeah, a little bit similar. Adam, I know, had a very successful crowd raise. We did a slightly different approach of, I think we were somewhat in the seed, but maybe in the early, still drawing on a lot of the friends and family who we hadn't actually invited to participate earlier in our company. And so there was actually a good bit of pent-up demand from those friends and family who wanted to get into it. And then piggybacking on maybe what Stuart said a few minutes ago, that if angel investors are motivated first by the heart, well, for me, as a company that's focused on combating climate change, I knew there was a lot of people that would have that heart. And so trying to find the people that, that this was already a theme, and they might get passionate about what we're trying to do and solve for the planet, and then bring those through.
Actually, on Avery's point there, it's a really good point, right? Like, this is what we're trying to do here is transformation and fight something that is, existential for the human race. And I think that is really critical what Avery's saying, is because the right investors came forward because the people we saw in the crowd equity were pent up, like, we want to do something, we're worried about this, we're seeing these bushfires, we're seeing these extreme events, what can we do? And I think that it's really exactly as Avery said, like, there's people who just want to get in on this, they just don't know how to do it.
So there's that common thread of storytelling. How do you get your story, your message, your communication out there into the market? So that kind of brings us really neatly into pitching, which is in essence in storytelling. So how do you prepare for that pitch? And Avery, you mentioned about tugging on heartstrings. So how do you prepare for that pitch, and what are your top tips when it comes to pitching?
Sure. Well, one of my maybe kind of sneakier things on pitching was to pitch to as many different types of people as I could. And maybe this was something that was taught and instilled at Startup Bootcamp when we were in Australia. Pitch to your grandmother, and pitch to your date, and pitch to all these different types of people, because if you can make sure that it's really understandable to someone who isn't within the industry and an expert on investing, if they get it, then you probably do have your story, and if they're following along with the story and interested, then you've really got it down. When you say storytelling, I think it is really that. It's not storytelling in a business context. It's storytelling in a storytelling context, and I think that's one that I've never seen anyone do better than Adam Bumpus. He's a heck of a storyteller.
That's a good segue to you, Adam.
So Avery would be on the stage just nailing the final line. I've never seen a final line in a pitch as good as Avery's. Avery's just kills it every time, and that's because he set it up really well. And I think that is it. Like, so with us, yeah, you have to tell this story. You've got to be, and I said, being authentic. But the other part is you have to pitch so much. You've got to pitch every day to all these different people. And sometimes you're so tired, and so it's like, okay, cool, give me your elevator pitch. And people like to push you a bit, and you're like, I just don't want to give it. But you got to switch it on, and you got to be super enthusiastic, because they're buying your enthusiasm as well. That you're in it to win it, and they know that if you're pitching with enthusiasm, and that 100% comes through. And even when you don't feel like it, you just got to switch it on. And then sometimes when you don't feel like it and you get into your pitch, you reignite your own excitement and you're like, okay, cool, this is why we're doing this. And then when someone goes, oh, I like that, suddenly you're off and you're away.
Awesome. We've got a few minutes left, so I'll just want to do a few quick fire questions just to kind of get this moving a bit. So challenges. So what questions were challenging? Adam, do you want to go first? What was your most challenging question that you got?
It wasn't necessarily a challenging question, it was a challenging attitude, which was super conservatism. Like, you know, if you're building something new, you're challenging the status quo of this massive 170-year-old industry, and people are like, well, what about your competition? What about specifics of your exit potential? And they're like, yeah, that's important, but it's more important that we're doing something here that's going to fundamentally rework the way we do things. There's going to be a lot of money made out of that. And I think the challenging questions were then kind of not really the standard VC questions, but the challenging questions were like, yeah, okay, I just kind of don't see how this fits in that context. Tell me about this. And because people just weren't taking the time to think through what we were actually saying. That was kind of a challenging one.
Avery, any challenging questions?
Yeah, I would say investors seem to be interested, rightfully so, in how can you build your moat around your awesome thing. And so, you know, we as the founders and company builders, we're trying to build something that's world changing and can even make money. And that's already a step forward of not only can you build it and have it make money, but I want you to be able to defend it against all of competition in perpetuity. And you know, it makes sense from an investor, but thinking that a couple moves on the chessboard of how to explain how you will have that moat is a challenge.
Yeah.
And you've both been in front of investors. You must have come out and like, I wish I'd asked that question. I wish I gave that advice. What's your top advice to investors? Avery, do you want to go first?
Top advice to investors? Sure. Well, I wish that I had asked them a little bit more for their own contacts because and recommendations, because once you have one investor who's committed, that is probably one of your best salesmen as well. And you know, that if you found one, then helping that found others. And I found that out a little bit late in the game and should have done that earlier. So.
Yeah, I think the other thing that I really wish I'd asked the investors is what is exciting you right now and what's exciting you in 3 years' time, because we've got to be thinking 3 or 4 years' time as young startups. And I didn't ask that enough of the investors about like what is getting them personally fired up right now in the energy tech world. And I should have asked that a lot more. And Avery's point as well, there's a network of people there. Just keep talking to them, and if they'll put you onto their network, even if it's not right for them, but they see the value and they want to pass you on, that's an amazing outcome.
Cool. And one last final question each. So this one's to you, Adam. So you're getting some pretty large household name corporates interested in you who are not from the energy industry. So what do you see as a benefit of this for your prospects in the future?
Yeah, well, look, we see energy as this commodity that's you know, no one really cares about electricity that comes out their plugs. They care about what it does. And so we're engaging with some pretty large organizations, like some pretty large property development organizations here, who are really interested in saying, how can we get this at scale? And so I think for us, building out what we call the Internet of Energy across, you know, large property developments and building it in from the very beginning when these constructions are going up is a far better way than just retrofitting. And so it's giving us this kind of whole new perspective on what a customer is and how to get to a customer at scale. And that's super exciting.
And finally to Avery, I know you're very consumer facing. So how has COVID impacted your business since online shopping has been a really strong uptick in this COVID-19 times?
Yeah, it has been obviously an interesting time for everyone, but it has been actually great for us in a sense that to realize that our business was so recession-proof and actually perhaps doing quite well in a challenging situation. You know, online shopping is how we as UCapture make our money, and that's a trend that's spiked in the last couple months, but probably is one that increases, you know, in perpetuity, I would believe. However, on the capital raising side, we had done 6 months of preparing for a capital raise, and actually launched our capital raise on the day that the S&P was down 10%. So, like Mike Tyson said, everyone's got a plan until you get punched in the face.
Also, on that, I think we will end. Thank you, Avery. Thank you, Adam, for your time and insights. I'm going to pass it over to Trevor to talk to Mark Bonner.
Hey, thanks, guys. I really love the enthusiasm, and I know it's tough work being startup founders, and you guys are doing just an awesome job. But now we get into the when we talk about love or money, now we move into the money side of the discussion with Mark Bonner, Managing Director of Southern Cross Partners. Mark, hi and welcome to the webinar, and thank you for spending some time with us today.
Thanks, Trevor.
And would you like to give like a 30-second just briefing on who you are and who Southern Cross is to get us started? Yeah.
Sure. Yeah. Very quickly, I started life on the other side as a scientist. I trained as a physicist in Scotland, actually, and then I was involved. I moved to Silicon Valley, actually, and I lived there. I was working in the semiconductor industry, and then went back to the UK and was involved in a couple of businesses that had private equity backing, and that was my first experience of finance. And I was fascinated about, who were these people that funded these high risk technology businesses. So for me, the move into VC, which actually happened via a role I had at CSIRO, was a kind of natural culmination of my interest in technology and my fascination with how it got funded.
Cool. So we talked to Stuart about angel investing to get started, but people may be a bit unfamiliar where VCs fit in. What role do they traditionally play in the life cycle of a startup? Can you dig into that a little bit for us, Mark?
Yeah, happy to. There's a few books on this, but I can give a very sort of high level sketch. I just thought an interesting bit of trivia to start off with, just following on from the angel investing conversation. Angel investing has been around forever. It's been around, really since people started trading with one another. But venture capital is actually a relatively new thing. The first recorded VC deal, the first institutional VC deal, was apparently 1959, which was a company called Fairchild Semiconductor, and it was backed by a fund that the Rockefeller family had invested in. And the big difference between venture capital and angel investing is that, generally speaking, VCs are investing other people's money, whereas people like Stuart are investing their own money. Usually there's a small amount in a VC fund. It's usually about 2% that comes from the manager themselves. But generally speaking, that's the big difference, and it drives a whole different set of behaviours, actually. Ashley, if you could just throw up the image that we had that kind of shows the sort of the capital chain. VCs live happily in the area I like to call the valley of death on this slide. This slide is really an American snapshot because it shows venture capital not coming in until the break-even point. If you can see along the X curve, that usually VC is here at the break-even point. But because the Australian market tends to be relatively early stage, Australian VCs, generally speaking, are investing prior to a company reaching break-even. So it's usually burning cash. Whereas, as I say, the US, to some extent Europe, and certainly my experience of China, is that VCs are really growth investors, which is a bit different to the Australian context. And in a nutshell, what we're doing here is we're buying shares in a company. Usually, again, in the Australian context, it's a senior class of shares, preferred equity, we usually call it. And we're doing it with the expectation of a high risk-adjusted return. And obviously, in the current market, that expectation may have dampened a little, but I would still say that it's in excess of a 20% IRR. And in fundy circles, that type of return is often classified as what we call alpha. And usually we're taking a pretty active role in the business. We're taking board rights. We've usually got specific shareholder rights.
So when you're jumping in before that break-even point, obviously, the way the world of finance works is, you have a lot of international models and all of that. Whereas in Australia, if you're jumping in early, then you're in a quite a different risk position. So how do you bridge that gap between what VCs are doing generally globally and then what VCs need to do here in Australia?
That's a really interesting question, because actually I think it comes down to the type of person that you often find in VC in Australia. And it's a bit similar to the US. So my experience of VC in Europe is that most VCs come from finance background. And, I think they have a fairly high level understanding of the technology or sometimes the product they're investing in. Whereas in Silicon Valley, and I think it's similar here in Australia, VCs, for the most part, come from a technology or an engineering background. So I actually think part of the de-risking process comes from perhaps a deeper level understanding of the technologies and the sectors that they're investing in. So again, just referring to something Stuart said that I thought was interesting. I mean, he's got very deep, very specific sectoral expertise, and I think in areas like energy investing, like biotech, like pharma, you really want investors who know, a bit about the space that they're investing in. So that to me is partly the answer. You have these specialist investors, in Australia that kind of know a bit more about what they're putting their money into.
Yeah, and particularly when the value chains are maybe quite opaque to others who are outside of the industry. Actually, we've got a little bit of a poll about investors. So do you want to pop that up on the screen? And we're asking people what range do they normally invest in? Or I suppose if you don't invest, then what range would you like to invest in even? Would be interesting to know. So yeah, if you could have a go at that poll, and we'll come back to that. So we've seen some concerns in the market and as Abs mentioned in his opening, that seed and early stage funding could be under threat as individuals become cautious around COVID and things like that. What are your views on this in terms of where we're at the moment?
It's very difficult to really speculate. The only guide that I can offer here would be to look at what happened, with VC and private equity at the back end of the global financial crisis. I mean, during that period, VC funds across the board reserved more for existing portfolio companies. I mean, they were anticipating longer times to exit, companies that would burn cash for longer. And the other thing that happened during that time was that raising new funds as a VC fund manager got harder. And there's a sort of a strange phenomenon that happened there, which was to do with private equity valuations get revalued more slowly than public market valuations. So if you're a pension fund, for example, and you've got public equities, they get revalued on a day-to-day basis, and we've seen that play out very publicly for some pension funds in Australia recently. Whereas, the private equity allocations are slower to revalue, and the upshot of that is that when the actuaries inside these pension funds look at their overall asset allocation, they find themselves overweight in private equity in a situation like this, and therefore the algorithm models that they use to define their asset allocation tell them not to put any more into VC and private equity. So it created a situation after the GFC that saw us not raising any new funds for the best part of a decade. Maybe not quite that long, but that's really my concern here. It's a double whammy. So it's going to be a challenging situation.
Yeah, let's see what the poll results come back with. Can we have those up on the screen? Yep. So there's a lot of people here in that 50 to 100K mark, which is interesting because that is the sweet spot for angels, and couple in the $1 million mark, which is interesting because I think they are the kind of levels that people should be looking at in the angel investing area. So let's move to the energy industry, and maybe we'll finish up there before we go to our questions. What major investment themes do you see emerging in energy or clean tech more broadly? And what investment types is Southern Cross looking at present, and so forth? And what should angels be looking at? What emerging things are interesting for angels, do you believe?
Mm-hmm. Well, the two sectors, and I'm actually going to refer to a report here that was published last year by Cambridge Analytics, not Cambridge Analytica, I should add. But it was a brilliant report of clean tech returns. It's publicly available, and if anybody wants to sort of approach, I can point them to it. But it was a report that looked at 1,500 investments across 950 companies, and the low returns were attached to renewable power manufacturing and renewable power project development. So these were things like making wind turbines, producing solar modules, or developing projects that incorporated those somewhat commoditized products. So they were trailing or dragging the overall returns of the sector. What were really driving the improved returns, and I'm talking about on-paper returns of 25% IRR, so really quite encouraging, were categorized as energy optimization and resource solutions. So they were the two sectors. And within those sectors, we had smart grid technologies, energy efficiency, energy management. So that's building and home energy management, energy storage, of course, water, so water treatment, purification technologies. And then there were other pretty interesting returns on an ag tech as well.
Okay, yeah, cool. Why don't I ask the all the panelists to jump back up onto the screen, and we've got a couple of audience questions here, and we'll bring the first one to Mark here, and I'm just gonna scroll through here and find it again. It escaped me. Audience question number one: to the investors, how often do you reassess progress? When do you decide to pull out, or conversely to stay in and add more? So let me start with Stuart from the Angel, and then we'll go to Mark with that question. Yeah, Stuart.
Yeah, thanks, Trevor. Really interesting one, and picking up, something in what everybody said so far, and my take on it. The challenge with startups is they've got no history, right? So there typically isn't 3 years of accounts that you can pore over and say, hey, there's some track record here. So as an investor, you're looking for authentic and capable people, passionate people with a clear vision to the farthest extent possible. But then you need some realism, right? And I think the real test here is, you as an investor, you never want to get to the point where they're about to run out of money, they haven't met their financial objectives, but you never put any milestones in the way, right? So what I mean by that is you can get to a point where you've explained and demonstrated discipline in execution. It might be getting to a particular version of the software, or getting to a particular success criterion in a trial or a pilot. And if at that point the business is running out of funds and requiring more, you can make an intelligent decision to say, hey, we've got 80% of the way there, it's worth putting more funds in. But you have to have that disciplined approach up front, otherwise you got nothing to rationalize your investment in. It's an emotional one as well, though. You've got to be clear that you're at some points there is a point where saying it's we're flogging a dead horse, and often in my experience, the entrepreneurs realized that. I mentored a guy for 2 years, tried every angle before he concluded. He said, I think there's no market here, and we finally agreed that there was no market there for him to get a product away in a way that he could make money. So you've got to have the milestones in place, then you can take some of the emotion out of the decision at that point.
Thanks, Stu. And Mark, in terms of follow-on from a VC fund, how do you think about it and progress and so forth?
We're usually triggered by a need for a follow-on funding round. That's the point at which we would, really review progress with an eye on, we're going to put more money in or not. And there's two types of follow-on round. There's one where other investors see hopefully what you're seeing in terms of the potential for value. So new investors coming to the table as part of a follow-on round is always encouraging. And in fact, we typically wouldn't lead, as an insider, we typically wouldn't lead a follow-on round because it's not seen as arm's length pricing. Or if we really, as Stuart was saying, if you really continue to believe in the founder and the mission statement, we will do insider rounds, but they tend to be done more as bridging rounds. So they tend to be, you kick the pricing can down the road until there's an independent pricing event.
Okay, I've got a question here, and I'll put this to Avery and Adam, which is trying to get a trial inside a client to prove a concept. How do you go about doing that? How do you convince a client, a large client, often if you're in the B2B area, to do a trial of your product so you can get some market validation? We'll go with Adam first. He seems keen. Yeah.
Sure. Yeah, it's always a challenge, right? Because they're a large organization, and you're trying to convince them that your small startup can actually add some value. But the critical bit is you've got to go in there and say, okay, here's how we add value. Here's what our technology can do for you right now, and here's what it can do for you in 5 years' time. I think you've got to give them a vision for what that future looks like. And secondly, the part that you can execute it. So you've got a team that can actually deliver on that project, because you're dealing with organizations who have a very much lower risk profile than you. They need governance structures in place to understand what you can actually deliver for them. And so I think it's going in and say, look, here's our big ambition. This is what it could be good for you. And right now we deliver these 4 or 5 steps, and here's how we've mitigated the risk in all of that.
And Avery, you've done some deals with some major banks in Europe and people like that, which are often very tricky and so forth. How do you go about convincing them to deal with a young, aggressive startup? Yeah.
Well, we were benefited greatly by yourself, Trevor, and by Startup Bootcamp. And I think that's the advice is that there are actually tons of accelerator programs, not all as world-class as SPC Energy Australia, but there are tons of programs out there to participate in, and they get you introduced to corporates, and that can help bridge the gap. So a lot of resources out there to apply. I see dozens of them coming through, every week, every month. So any other founders that are looking to do it, make use of those resources. There's mentors out there. There's programs to get into, and those can help you get that first foothold.
Could I add into that, Trev?
Yeah, absolutely, mate. Yeah, go for it.
I just thought it's a beautiful question, and I've seen it from the investment side and from the startup side. And with bootstrapping, right? It's always a bootstrap thing. Get a customer, get a product out of market. My strong advice would be, having been on all sides of that one, is one, be as honest as you can as how far down that process you are. But related to that, don't rely on one customer. You have to be having 2 or 3 or 4 or 5, because you can become overly dependent on the success or failure of one conversation. And the bit that I see most often as a failure or a shortcoming is people get to a trial and then, they think, great, we're there, but there's no revenue, there's no milestone, there's no success criteria. And I see this whole milieu about mutual respect. You have to respect yourself as an entrepreneur. You have to have a respectful conversation with a customer about, if we did that, what does success look like? Can we at least get to a letter of intent or a MOU that if we tick the following boxes, you will then roll this out to the first X thousand customers? And people are often reluctant to have that conversation because they're frightened that they might not come on board. My view would be, well, if they're frightened about coming on board in that, look for another customer. So I think, however hard that is, that's my best take on that. Great question.
Yeah. But thanks, Stu. And it is, when you're doing that, is at the starting point. And that brings us to the ending point, actually, of this webinar. So I really thank the panelists, Mark, Stuart, Avery, and Adam for joining, and my co-host here, Abs. Thank you, everyone, for getting involved. If anyone wants to get in contact with any of our presenters, their details are here. If you want to snap the screen quickly, you'll get our email addresses. I'm sure Adam and Avery would love to hear from you. And if you want to learn more about angel investing, snap the QR code. We're running an Angels Bootcamp on Tuesday, the 4th of August, where we'll delve into these topics a lot deeper. So over to you, Michael, just for the wrap. So Michael, we can't hear you. So it looks like
that was
Michael.
A great conversation. Thank you, everybody. I appreciate all of your participation. I thought it was very lively and very informative. So on behalf of Enlit Australia and Initiate, thanks for your time and thanks for your insights. I'd like to remind everybody you can see a copy of this if you go to inlit-australia.com. You also have access to all of our other digital content. There's a number of interviews and other webcasts there. So looking forward to seeing all of you at our live event in March 10th and 11th next year. It's shaping up to be a very vibrant event as the world emerges from the pandemic. And again, everyone, please stay safe. Thanks for your time, and thanks for joining us, everybody.
Thank you, everyone.